Hello, friends, and welcome back to Market Shares. I'm your host, Tony Blodgett, and today I want to talk a little bit about interest rates, about margin compression, about driving profitability. If you're someone who is in control of your P&L, whether it be at a branch level, a regional level, doesn't really matter. There's some basic things that we should all be looking at. But I'm going to start with this conversation. I want to talk a little bit about, some of the resources out there that people use to benchmark interest rates. And I'm going to bring up Mortgage News Daily because it comes up a lot. I personally think that Mortgage News Daily is a really great service, right? If you haven't been there, if you haven't checked it out, it's a website that compiles data from a number of different mortgage companies and really of all flavors, right? So you got, independent mortgage companies, you got banks, you got wholesale, etc. And what they try to do is they try to adjust it out to give you what a reasonable interest rate is, without paying any points. So they adjust for the points. And I'm going to talk about that in just a second. But one of the challenges with any kind of service like this, the simple fact that the data is coming from multiple different sources, the first kind of variable that I think comes into play here is compensation. Now, they do mention, if you go to their FAQs, which if you use Mortgage News Daily, I would encourage you to go to the frequently asked questions because they clarify a lot of how it is they compile this data. And it does say in there that the compensation, doesn't matter. It assumes kind of a median compensation. Well, I'll be honest with you. I see compensation vary widely across the country, and different originators, even in the same market, might be at different compensation plans. It's not uncommon to see some of the very best producers in the country that are running comp plans, in the 50, 55, 60, 65 basis point range, which, I think to a lot of people seems like a low number, but it's a high volume strategy. I see a lot of loan officers kind of in that 90 to 110 range. That seems to be pretty normal these days, with the average probably being around 100 basis points, maybe even a little bit lower. And I'm talking about self-sourced mortgage originators, but there's certainly markets around the country that are still in that 125, 150, even some people up above that 175, et cetera, on their compensation. So it's very difficult to account for that when you're trying to do this calculation. When I look at Mortgage News Daily in particular, I make the assumption of around 100 basis points comp plan. Now, is that accurate? They don't say. They're not specific in their on their website about what the actual compensation would need to be able to do a comparison. Matter of fact, they say, hey, this tool is really best used to compare the movement in interest rates day over day, not to compare where you're at in the market. But if you are significantly higher or significantly lower, then you may be out of the market potentially. But a lot of loan officers use this as like the gospel. They're like, man, this is where Mortgage News Daily is. This is where my rate should be. So I want to talk about a few other things that are mentioned in their FAQs that you might not have given as much thought to. And the reason why this is important is because I think everybody right now is trying to benchmark, am I competitive in this market, right? And this is one way to do it. You can look at what the MBS is doing. You can look at what online lenders are publishing, but we all know that rate tables and all these, they have multiple discount points. You don't really know what the disclaimers say. Some are based on really high loan amounts with, like the perfect unicorn buyer needs to, be involved. So Mortgage News Daily, is a really easy source to distill it down, but there's still some things about it that you need to understand. First of all, the compensation, I just talked about that. But the other piece that I thought was really interesting as I was reading through their FAQs is that because they adjust the interest rate that they're publishing for discount points, what that means is, and they actually give an example on their website, what this means is that it doesn't necessarily mean that people are quoting that particular rate at par. they've adjusted it to par. So let's talk about what that means in reality. So let's just say that the interest rate was 7%. It was slightly under that. I mean, last week it was like 7.96. I think on Monday or Tuesday, the week I'm recording this, it was at 6.85 or somewhere in that neighborhood. But let's just say 7% for the sake of this illustration I'm going to give. But one thing that is important to understand is that lower coupons, especially in a market like this, have more liquidity to them, and those tend to be the ones that are trading. So I'll give you an example. Like, we're talking about rates around 7% right now, high sixes, whatever the case may be. I'm talking about an agency loan right now, a Fannie Mae mortgage-backed security, for example. But yet the coupon that everyone's watching, like if you use MBS Highway, which I highly recommend, or any other source out there, they're usually tracking like the 5.5% coupon. So you're watching the candlestick charts. We're all familiar with this, but it's the 5.5 coupon. And so let's say we have a rally in the market and you're looking at the 5.5 coupon and it rallies, 25 basis points. You're like, well, I should see a 25 basis point move in my cost on my discount points. But the problem is, if you're quoting a rate that's close to 7%, well, that's not going into a 5.5% coupon. That's going to be going into probably a 6% coupon or 6.5 potentially, probably not a 6.5. That's going to probably go into like a 6 coupon. Point being is that there's limits on how far above or below that coupon you can actually sell that loan in that coupon. So if the 5.5s improve by a quarter, but the 6 or 6.5 only improves by nothing sometimes they get worse. It's really a weird phenomenon that can happen. Literally, you could see a 6.5 rally by 25 basis points. A 5.5 rally by 25 basis points. The 6.5 could get worse. And you're looking at, MBS Highway or whatever your service is, and you're like, I should see an improvement. But you're looking at the wrong coupon. And the only way to get into that coupon is to pay discount points, which apparently no one wants to do these days, right? And that's part of what I'm going to talk about today. No one is quoting interest rates with any amount of discount. And I get it to an extent, and we'll talk about that. But my point is this, is that if someone submits their rates to Mortgage News Daily, and let's say that they're using a rate of 6.25 with 2 discount points. Well, Mortgage News Daily is then going to adjust that to come up with what would be close to a par rate. And the best I can tell, they use a multiple somewhere around 4.3 to 4.6. And so that would take that 6.25, and using round numbers, let's say it's 2 points, and then we're using a 4% multiple, which I think it's even a little bit higher than that, but let's just say it was 4. That would take you to 6.75. So now you'd look at Mortgage News Daily and say, rates today are at 6.75. Well, rates today are at 7. And you're like, well, I must be out of the market. Well, not necessarily, because you could have probably done that 6.25 rate with 2 points, just like, the lender that sent in their rates, but you're trying to quote right off of par rate. And I know that this is confusing for people because most people's pricing engines just default when you go into Optimal Blue or whatever you use for your pricing engine. It typically will show you closest to par. And that's kind of where our eyeballs stop. But what we don't always take into consideration is if I moved deeper, the value of that rate would be much better if it's into a better price coupon, into one of those lower coupons. And so this is one thing that I think most people don't understand about a service like Mortgage News Daily. When you remove the discount points, then you have to then take into consideration what is the adjuster they're using to make up for those discount points. And now all of a sudden you're comparing yourself with a loan that's in a 6.5 coupon, let's say, to a loan that's in a 5.5 coupon and wondering why you're out of the market. And again, they don't give you all of these details. So I don't know how many of the surveys that a company like Mortgage News Daily got back that were averaging 2 points or 3 points or 1.5 or, who knows? You don't know. All they tell you is that they have a proprietary algorithm that calculates for that. And what I'm trying to explain is in that calculation, it's not going to be a perfect translation because the value is better at lower coupons. It also, in my opinion, begs the question, Why is nobody, and I don't want to say nobody because I know people are doing this, but why are most loan originators only quoting par interest rates? Now, I understand that we have a fiduciary responsibility to our clients, right? We need to advise them on what is the best scenario for their needs. And many people will say, Tony, why would I charge any discount points if I know that my borrower is going to refinance in 6 months? I mean, I hear that all the time. Well, you don't know your client's going to refinance in 6 months. Matter of fact, if I would have asked you 6 months ago, did you think rates were going to be lower today? You'd say, oh yeah. Are they? Not really, right? If I asked you a year ago if you thought rates, if you asked me a year ago if I thought rates were going to be lower right now, I would have said absolutely I did. I was wrong. People, we don't know is the bottom line. We can give our best estimate on what we think it's going to do, and we can provide supporting data on why we think that, but none of us have a crystal ball. You've heard this all before, and it's 100% true. So the question is there potentially an interest rate that has a slight cost to it? Maybe it's not 2 points, maybe it's a point, maybe it's 3/4 of a point, but that is giving a significant better value to your customer. And it's our responsibility to do that research and then present them with their options. This is where a tool like MBS Highway, Mortgage Coach, these sorts of resources that allow you to do side-by-side comparisons for your borrower and say, look, I'm going to suggest that we pay 3/4 of a discount point. And here's why. Because I can improve your interest rate by this much if we do that. Your break-even point on that is 14 months out, as an example. And do you think you're going to be in this home for that period of time? Now, there's another benefit, in my opinion, to starting the conversation with a borrower where you've introduced the idea of paying some amount of points. And what it is that when all you are quoting is a par interest rate, then your customer, when they go do their comparison, two things happen. One, they're just looking at 0 points and a rate. So now you've completely commoditized yourself. And I would argue you are potentially not fulfilling your fiduciary duty by showing them an example of a way that they could actually get cheaper money at a much reasonable price with a short break-even period. So the introduction of discount points, in many cases, especially knowing that the value of money is better, the value of these rates is better in lower coupons, maybe there's a way to edge them into the next lower coupon, get more bang for their buck. Yes, there is a discount associated with it, but it might still be the best deal for them, and we should at least be presenting them their options. Now, the other benefit of doing this is it shifts your conversation into being a true advisor to your clients. So over here, I'm just saying, look, no points. Here's the best thing I can do. Over here, I'm saying, look, I worked up a couple different options for you, and one of them has some discount points, and this is actually the one that I'm recommending. And here's why. Because with this amount of payment of points, I can save you this amount of money. You're going to recover that in whatever that number is. Maybe it's 18 months. Maybe it's 14 months. Depends on the situation, obviously. But one other thing that's happening in the market right now is over 40% of transactions nationwide are happening with seller concessions. And that number has been increasing significantly. I wouldn't be surprised if at the time of this being published that there's data that it's a higher percentage than that. So there is a possibility that you can negotiate the seller to contribute towards those points, etc. And even if they don't, I still think that having that conversation is helpful. Now, a lot of loan officers would tell me, Tony, no one wants to pay points. And I'm like, fair enough. Then have that conversation with them about what it looks like to not pay the points and what the interest rate would be. I'm just suggesting maybe don't start there. Start with what is the best value for them, knowing that they're going to be in this home for a period of time, and then talk about, well, what are the drawbacks of that? Well, one of the drawbacks is if interest rates drop significantly in the next 6 months, you've paid these points, then it might have been wasted money because we're going to refinance you anyway. If you strongly believe, Mr. Borrower, that interest rates are going to drop significantly in the next 6 months, maybe it doesn't make as much sense to do that. But I just wanted to give you these options. Now, as you can see, that's a very different conversation than here's my best rate at par, here's my loan estimate, go shop around and let me know if someone beats me, right? Like that's super frustrating. What we've done here is we've shifted this conversation into a consultation. We're advising our customers on their options. And I would argue there's definitely circumstances where a little bit lower interest rate with a little bit of discount is truly in their best interest. And then there's all the other benefits of shifting the conversation to be this, a little bit more complicated, but this is advice, you guys. This is being an advisor to your clients. It shows your understanding of money. It helps them understand how interest rates and money work, and it increases the perceived value in what you're bringing to the transaction. So I just want to point that out. So hopefully that makes sense. Just know that if you're using a tool like Mortgage News Daily, you have to take into consideration all of those points that I brought out. It's not always a true apples to apples comparison. And if you're not considering ever selling any discount points or even a fraction of a discount point, I would encourage you to reconsider your strategy and use a tool that helps you illustrate for your borrower what makes the most sense. And I'll just point this out. There is not an interest rate quoted on the internet, especially on a rate table. Maybe some banks or credit unions, they might quote rates with no points. Not usually. Almost every interest rate that you see quoted somewhere, and this is why they have to disclose APR, which is super complicated and people don't understand what it means, but that's the rule. The reason they have to show APR is because there's almost always points associated with it. And why do you think that every online lender, why do you think that every rate table, every lender that puts their rates on a rate table, why do you think they all start with points? Because it works, right? The borrower keys in on the interest rate, and then there's a conversation about the points. Now, I would argue that most of those rates are not in the customer's best interest. A lot of them have 2, 3 points. Yeah, I'd be hard pressed to feel like that's a really good option. But adding a quarter, a half, 5/8, I don't know, maybe a 1.5, depends on the situation, especially if you know you can negotiate the seller to pay it. And not knowing what interest rates are going to do here in the coming year, especially in a market where you're dealing with a lot lower loan amounts. Look, if you're doing $800,000 loans, a small movement in rates typically makes sense to refinance. Much lower interest rate or much lower sales price markets or lower loan amount markets, it doesn't make as much sense. So, if you're in California, your strategy might be different than someone, who's in the Midwest, for example. So anyway, all food for thought. A couple other things that just come to mind, and I deal with these in my day-to-day all the time, is many times people feel like they are getting shopped for a loan. Someone else is quoting a much lower interest rate than you are. And many times your first thought is, we must be out of the market, right? Doesn't matter what company you work for. Everyone thinks I must be out of the market. Well, what we find often is that people are missing little opportunities to actually get better interest rates. And I'll give you some examples that come to mind. There's probably a lot more than this, but one of them in particular that happens a lot is people will put in, too much income for a borrower. So a lot of times we're used to trying to, we gross up their Social Security. We look for all the overtime and bonus income that we can. We have all this variable income and we get years of data to try to justify using all this variable income. Well, you ever thought sometimes adding all that variable income in, which you're sitting here trying to battle with an underwriter to consider, isn't even necessary and might even be disqualifying them for certain loans that have LLPA waivers based on the median income in that area? This happens often. We see people grossing up income, using overtime, things of this nature. Borrower's got a 32 ratio. They don't need the extra income. And you just put yourself $4,000 a year over what is the median income level that's needed to qualify for an LLPA waiver with Fannie Mae. And all of a sudden, a 1.5, 0.58, 1.75 points would have went away, and all of a sudden you're super competitive. Is it possible? Is it possible that your competition found that option and is quoting that? Because when you're 2 points out, chances are there's something else going on. I'll give you another example. Jumbo non-QM, right? If you're in a space where you do a lot of jumbo loans, you have to go into your pricing engine and click non-QM as well. I mean, not all companies have, as many options, but it's a best practice, in my opinion. Choose jumbo, choose non-QM, look at all of the options, because many of your jumbo and non-QM lenders will actually do conforming loans. And depending on the LLPA adjusters, you might see a significant difference, especially on like second homes, non-owner occupied, things of that nature. You might see some differences, and you just be surprised. So just little things like this can make a significant difference in the price that you're quoting. And it's not that the margins are off. It's not that your rates are out. You're just looking at the wrong program, or you're missing a program that your borrower may have been eligible for and you weren't looking for it. So really pay attention to those things. Here's another thing that I see people do often is they're in their pricing engine and they say, I'm looking for a par interest rate. And so you might have multiple investors that come up. And so you look at the one that's the very best price because your pricing engine defaults to par, I'm assuming. In most cases it does. And you go, well, the very best price is ABC Mortgage. So you click on that, you expand it out, and you're like, but my borrower has some money from the seller, so they're going to pay a point. So I'm going to go down to 99 and I'm going to price the loan there. And, but what you don't realize is that there might've been another investor who at 99 is a significantly better price. You get more bang for your buck because it is not equal across all lenders. So you need to go into your pricing engine and say, okay, I really want this price, not I want par or I want this rate. I want this price. Which investor if I'm paying 1.25 is going to give me the best price? Or better yet, sort by interest rate. I want to look at this particular rate with all of my different investors. Which one's going to cost me the least amount of money? So slicing and dicing your data in your pricing engine multiple different ways before making an interest rate determination that you're going to quote to a client, I think is really, really important. And again, it's something that I see people miss often. It's a missed opportunity. And then you really need to look closely, because if you're quoting 6 3/8 with a particular investor, I've seen rates 6 3/8 can be 3/4 point in discount worse than 6 1/4. Like you might just go to 6 1/4 and charge them 1/4, instead of 6 3/8. It might be that big of a difference. Oftentimes it is. And that's right on that bubble where a loan could go into one coupon versus another, like I was talking about earlier. You got to look for those things. And I know all of you, if you're an active loan officer, you know what I'm talking about. You've seen these spots. You may not understand why it's happening. You might go, "What? How come every eighth doesn't cost the same amount? It jumps around." Well, this is why. But it really takes us to slow down and look at every single option before we quote a rate, because oftentimes you're getting beat because someone just chose the right program for your borrower. They chose the right note rate at the right cost, etc., and it made a significant difference in the bottom line. And those opportunities, it's kind of like finding gold. It's all over the place, but you got to know to look for it, and you got to take the time to identify those opportunities and make sure you present those to your borrower. And next time you're getting beat significantly, look for those. Look for those opportunities, what you could do. Oftentimes you could lower the rate, charge a little bit of discount, and you could even give a lower rate than what the borrower is being quoted, but maybe they'd be happy with a little bit of discount. Okay, a couple other things. So in inverted margins, you got to watch for those. I talked about the non-QM, jumbo, second home. All those things are really important. Okay, ARMs. I want to talk about ARMs really quick, because I was just looking at a chart the other day at the spread between a 30-year fixed rate mortgage and a 5-year ARM. Now, this holds true for 7-year ARMs as well, but the chart I was looking at was just 5-year ARMs. And for you guys, most of the last, decade, those have been basically tied together. There was very little spread. And you've seen this if you've been in the mortgage industry, like ARMs just didn't make a lot of sense. Now, some banks that were going to, especially on portfolio jumbo loans, you saw a lot of use of, 5-year ARMs, 7-year ARMs. Those were typically portfolio loans that they were, holding, and they would decide like how much they want their rate of return to be, and they would do that. It didn't necessarily correlate to the market, I guess is what I'm saying. But now you can look at Fannie Mae, Freddie Mac ARMs, and oh boy, they have gotten, significantly better of recent. And if you look at a chart, you can see it. You can see the spread has widened significantly on ARMs versus 30-year fixed. So now all of a sudden it might make sense to do it. Now the challenge with a 5 or 7-year ARM is, depending on your total margin and compensation and all those things, it might be difficult to get to par. So you might be looking at quoting, a half point, a point. It depends on the situation. So you might be looking at a little bit of discount. But it's such a pickup over a 30-year fixed that, again, you got to go back. You have to be an advisor to your client. You got to do the math. You got to determine the break evens. This is not rocket science, but it is math. It's like 4th or 5th grade math. So we got to do that. But, explain to our borrower the pros and cons, but it's definitely an option. And if I was doing like a mortgage coach analysis with some side-by-side options, I'd look at my very best value that I could find that may or may not have discount points. I'd look at something maybe without any points, and I would definitely throw an ARM in there. I think having an ARM is a good idea. Another good idea when you're doing like a presentation to your borrower is just throw a 15-year fixed in there. Not because it's going to be super competitive or anything, but it allows you during your consultation with your borrower to have a conversation about accelerating the payoff of their debt, becoming mortgage debt free, right? It's just something that everybody is interested in. So you could show them what that would look like. Most borrowers won't opt for that. And the spread between a 15 and a 30 doesn't really make it worth a lot of sense. But if nothing else, you get to then, build the rapport, build the trust, and show them. Again, you get to take more time in the advice category, in my opinion. So just an idea for you there. So ARMs, keep an eye on the ARMs. They've gotten a lot better. Also note that, you really do have to look between different investors. I know a lot of people get really comfortable with one investor, especially if you work for a company that services their mortgages. You want to deal with that if you can. But even people in the broker, in the broker community, right? They get very dug into their favorite lender. And but what's happening right now is you see servicing values fluctuating drastically. And matter of fact, I don't want to pick on anybody, but I'm going to mention that Penny Mac, who is an investor, both correspondent, I think they do wholesale as well. They showed a loss for the first time in the first quarter for a very long time. They've always been profitable, but they showed a loss in the first quarter of 2025. And I've been looking at the multiple that they're paying for servicing, and you can just see it. You can just do the math, right? You can see what their rate is compared to one of their competitors, and they're paying a better price. And you go, why is that? Well, they're paying more for the right to service that loan. And we've talked a little bit about this, like why would someone do that? Well, because they expect to recapture that loan maybe a couple times in the future, right? So if you do your loan with a company who's paying more for servicing, you're risking the fact that they're going to restructure that loan. You might win the loan today with your client because it's a little bit better price, but you might lose it the next time around because they're going to be very aggressive at retaining that business. But my point is this, is that if they're showing a loss, I believe it's because they were, pushing the limit on what they were paying and servicing, and now that's starting to play itself out. So I wouldn't be surprised with the shift at the market scene if we see those get back down to a more normal multiple that people are paying for servicing. But right now, it's all over the place. So what does that mean to you? It means you got to be willing to look at multiple different investors to see who's willing to pay the best price on any given day. And that can be frustrating. That can be frustrating if you want to go to a certain lender because you like their technology, you like their underwriters, right? If you're a broker, as an example. But you need to look at other options. And if you're a mortgage banker or a bank and you service your loans, you might want to stick with your in-house servicing, but maybe there's better options out there that you need to consider. And And in a market like this, where every deal counts, you got to be willing to make those decisions. Oftentimes, though, you can educate your client and say, look, here's the reality. I could get you a little bit better price, but I know that this company sells their servicing to this horrible company that does their servicing, and I want you to have a great experience. So it's going to be a little bit higher price if we go with this or we keep it in-house, but I'm always going to be a resource for you, right? As an example, it's okay to have those conversations with your client. And then if they say, you know what, price is all I really care about, then at least they had the option. And if you made the decision on your own that I'm only going to quote them the in-house price because I know that the servicing experience is better, well, you might lose that deal because all they care about is price. So having a transparent conversation sometimes with your client can, it's just really good to give them choices and give them advice on what you would do. But ultimately, it shows them that you have options and they're less likely to shop around. Look, here's what statistics show is that clients like to shop around, but they're okay even shopping with one person. Here's what I mean by that. If you did an analysis using MBS Highway or Mortgage Coach or a similar, and you gave them 3-4 different options that you walked through with them, that satiates their need to shop around to some degree because they feel like they looked at multiple options. But when you only give them one option at par and say, here's the deal, now they're inclined to go shop around. Now, look, I know that it's in a customer's best interest to shop around and make sure they get the best deal. I'm not saying that we should, discourage them from doing that. I'm just saying they're less likely to want to do it when we give them options. And it also helps us shift our conversation from a very single, point, like this is the rate at zero fees, and it helps us talk about why they would want to even consider other options. So hope that makes sense. Now, and this comes up all the time when I'm talking to loan officers that tell me that they gosh, Tony, I just lost this loan. I just lost another one. And I'm like, okay, well, what was the situation? Well, they already came to me and they already had a quote from someone else. And, I'm like, oh, so it was like a second look. Like they're already pre-approved. They're already with somebody else. You're just giving them a second look. Yeah. I'm like, well, then you didn't lose anything because you never had it, first of all, right? And second of all, if that's happening in your business a lot, I would think about how do I shift that? Now, if you're a newer loan officer or you don't have, deep relationships or it's a new relationship, I get it. Oftentimes you're going to get that second look, but we have to be very intentional about moving from being second chair to first chair. And how do we do that? Well, we got to talk to our referral partner. Like, who is that person that's referring you? How are they referring you? What are they saying about you that's putting you into a competitive situation every time they send you a referral? And maybe that's just the way that they prefer to do business. Well, maybe that's someone you'd want to choose not to do business with if it's causing that much frustration and every time you're being pinned against somebody else. So really think about moving yourself from second or third chair to first chair when you're working with a referral partner, and be intentional by asking them questions about how they refer you, what's important to them, so on and so forth. And just know that if you feel like you're losing deals, but you're only getting second looks, don't be too hard on yourself. That's a tough place to be in, to always be trying to steal a deal away from somebody else. If you're in that situation, in my opinion, the most important thing is to be the advisor, right? Slow down, like we've talked about. Have a thorough needs discussion with your borrower. Do a very thorough mortgage coach presentation with them. Really spend the time to get to know them, and just hope that the person who gave them the first quote didn't do as good a job. Now they're going to feel more connected to you. And now you have an opportunity through the relationship to earn that business, not just based on the interest rate that you can quote. And lastly, I would say you guys, pull through numbers are the worst I've ever seen them. Meaning if a loan officer meets with a client, takes their application, the pull through on that in certain markets has been very low. I would say a historical average is around 75% pull through. People that you quote, 75% of them should do business with you. And it's much lower than that right now. And I'm hearing numbers as low as like 30%, meaning 70% of their clients are going somewhere else to get their mortgage after they meet with them. And many times it's because of a competitive rate environment. The reason I bring this up is, and we could probably do a whole other episode on how to increase your conversion, but the only thing I want to point out with this statement is that know your conversion numbers, because I know that it's frustrating to lose even one transaction. Like if I'm a loan officer, I lose one deal, and it just ruined my whole day, and I'm very frustrated. But if I look back and I go, well, out of my last 10, I only lost one, like you're doing pretty good. Like don't beat yourself up. It's okay. This is a numbers game at the end of the day. This is sales. It's a numbers game. So don't beat yourself up too much if your pull through is still really, really high. So you got to know that number, track that number. Now, if it starts getting to where, out of every 10 people I meet with, I lose 7 of them. That's a problem. Something might be going on. Something might be going wrong in your process. You might have horrible referral partners, right? So you're always getting that second, third at bat, but you should still have a better conversion rate than say 30%. So just know that number and then let yourself off the hook. Let your company off the hook a little bit, right? Sometimes you're looking at your company, go, man, our rates are out. I just lost another deal today. It's like, but how many have you won? I mean, are you really losing more than you're winning? Like know that number and just remember that this is a numbers game and it's okay to lose a few because the focus is on lead generation. And yes, you want that conversion to be as high as possible. But if you're in that 75% range, I would argue in a market like this, if you're in the 65, 75% range on your pull through, and these are good referrals, you're probably doing okay. I wouldn't beat yourself up too much if borrowers shop. I mean, the propensity to shop is very high when interest rates are high, right? Everyone they can't believe they got to pay that high of a rate. They're going to see if there's better options. And through that, people get roped in. They find a loan officer who takes more time, who has a better pre-approval process. They educate their client, and the chance of losing them goes up drastically. So you guys, that was my thought for today. Look, this is a little different episode, but I hope it was helpful. I'm just sharing with you experiences of things that I see every day in the mortgage business, and I wanted to share them with you. So if you're not in the mortgage business, you might have thought this was probably an episode that didn't resonate as much with me, but I hope you learned something. I hope you took something away from this, even if you're in real estate or just a consumer that likes to watch our podcast. And with that, you guys, look, I appreciate the people that do tune in every week. I see people that tune in both on the podcast and on YouTube, but we want to continue to grow it. So if this is content that resonates with you, I would ask you to please let someone know about it. Share it with a colleague, someone else that you think could, get some value in watching this. And also subscribe to the channel because that helps us out a lot. But you also will make sure you don't miss the next episode, which is going to drop every single Friday at 10 a.m. Pacific time. And until then, take care.